What's going on, guys? This is Brooks Beard, Mr. I Do Mortgages, NMLS number 940533. And today I want to talk to you guys about how to buy a home in an LLC using the DSCR program. All right, and who am I? And basically, I'm a branch sales manager at Geneva Financial. I've been in the industry over 11 years, and I've helped over 1,500 people either purchase or refinance a home. And I have funded over 370 million in volume in the last 11 years. So guys, just know I've been around the block and back. You're in great hands, and we have some great information for you regarding the DSCR program. Now let's kind of dive into the DSCR program. And DSCR stands for Debt Service Coverage Ratio. And what we found is 51% of self-employed borrowers use DSCR. Okay. So, a lot of self-employed borrowers write off a lot of their expenses, so they don't have to show as much income, which will help them not pay as much taxes, which I certainly understand that. I'm self-employed myself, and I use a lot of the same strategies. Okay. So this particular program will help self-employed borrowers purchase investment properties and only have to leverage the cash flow to qualify. Okay. The second largest group to use DSCR is real estate investors. Okay. Same advantages. They can use the cash flow of the property to qualify instead of having to, go through a full document loan like a conventional loan would require. Okay. Now, this program is only for investment properties. Okay. This is not for primary residences or anything like that, second homes. This is for investment properties only. Okay. And you cannot be a first-time home buyer and utilize this program. You must already own a home. And you're looking to either purchase your first investment property, or you're a seasoned investor and you're, looking to add more to your portfolio. And again, DSCR borrowers can't occupy the property. So again, you can't buy this as a primary. It must be an investment property. All right, so here's some of the features of the DSCR program. There's no DTI, so you don't have to worry about debt to income ratio. There's no employment needed. You don't have to have a job. There's no income needed. No vacancy factor. So basically what happens with the vacancy factor, when you're doing a conventional loan and you're utilizing and you're buying an investment property on a conventional loan, we have to use a vacancy factor of 75%. Okay. So we can't use 100% of the rent to qualify you for that rental property. We can only use 75%. However, with the DSCR program, we can use 100% of the rent to qualify you. Okay. The repayment is based on the cash flow of the subject property. All right. So we look at more of the cash flow of the property in comparison to your income, right? Because there's no income. So they just look solely at the cash flow. You must have a minimum credit score of 660, and they will do loans up to $2 million. And this program also allows you to vest in an LLC. Okay. So if you have an LLC, you can vest the title in that LLC. Okay. And however, you have to have a max of 4 borrowers in the LLC. Now, some of these features that I'm going over with you is based off of the investor that our company uses. So some other investors may have slightly different guidelines because these are what you call considered a non-QM loan, non-qualified mortgage. So these are not backed by Fannie or Freddie Mac or any government. Okay, these are private lenders that portfolio these loans into their own portfolio. Okay. All right. So here's some other features of the DSCR program. So if you are a seasoned investor, you have more than one investment property, the down payment requirement is 20%, or we would say the loan to value is up to 80%. Okay. For first time investors, the loan to value is 70%, meaning you have to have 30% down. Okay. If you're a first time investor, all right. Again, no first time home buyers allowed. Typically what happens, the investor will utilize the lease agreement, okay, or market rent to determine what rent we're going to use, okay. Typically look at the lesser of the two. However, if you have a lease agreement and that lease agreement is higher than what the market rent is showing, and you can provide 3 months of receipt of the lease, the rent, then we could leverage that. Okay. Airbnb is fine. We'll either look at the market rent or the average of the last 12 months rent. Okay. Because some people may just, recently got this Airbnb, property in an Airbnb, and they may not have a full 12 months of renting it. So we can still use market rent to help you qualify. 1 to 4 unit properties are okay. It could be, townhouse, a condo, single family residence. It could be a 2 to 4 unit property, etc. Okay. Now, non-warrantable condos are okay as well. And I know you probably wonder, what is a non-warrantable condo? And basically what happens, non-warrantable condos don't follow the requirements of Fannie and Freddie Mac. Okay. Because typically what happens, some condos may have delinquencies in their HOA dues, which makes them non-warrantable now. Okay. Or they may have, a certain percentage of investors compared to primary residents that owns the properties, which will make them non-warrantable. So there's certain things that, and there's more other things, but those are just to name a few. The terms that are allowed are 30-year term, could be an ARM, interest rate only, or fixed rate. And you must have at least 6 months reserves on the subject property. However, it's not needed on other finance properties. So if you were buying an investment property and you're going through traditional financing through a conventional loan, they will require you to have reserves for the other properties that you have financed as well. But through this program, it's only on the subject property. Okay. You can also do a rate and term or rate and term refinance and a cash out refinance. Now, if you're doing a cash out refinance, they will allow you to cash out up to $500,000. Okay. And gift funds are allowed, but you must use 10% of your own funds. All right. And I know a lot of you probably wonder, well, how do they come up with the calculation to make sure that this property is cash flowing properly? And this is the calculation that they use. So they look at your gross rent, okay, divided by PITIA, which is principal, interest, taxes, insurance, and association dues. Okay. So just to kind of give you an example, let's say your gross rent was $2,500. The PITIA was $2,000. Okay. That equates to 1.25%. So as long as it's at 1 or above, you will be perfectly fine. Okay. All right, so that basically sums up the DSCR program. I hope this information was helpful. And if this is something that you truly want to leverage yourself, feel free to reach out to me. As you can see here, my email, bbeard@genevafi.com, my Instagram at Think and Bank, at Brooks Beard, and Mr. I Do Mortgages. Or you can go to my website and at MrIDoMortgages.com, schedule a call, and myself or someone on my team will be glad to speak with you and get you in the right direction. So again, I hope this information was helpful, and I will see you guys on the other side. Peace.